and it is now my pleasure to introduce Rob Salvino. Rob is our research economist for the Center of Economic and Community Development at Coastal Carolina University. The center is housed within the E. Craig Wall Senior College of Business Administration. He earned his PhD in economics from Georgia State in 2007. As our research economist, Salvino monitors economic activities at the local, state, and national levels. He provides economic projections for the region and serves as a liaison between the business, government, and academic communities. Rob, it's all yours.
All right, thank you. And I want to thank you folks for coming out here. We really appreciate it, and we look forward to this each year. So we've got a great panel today. It's going to be very interesting, and particularly our keynote speaker when he follows from the upstate, interesting region of our state. And of course, they've been a very successful region for economic development, and it'll be just interesting to hear their perspective. So what I want to look at today, though, since we're talking about economic diversification, I'll talk about just the changing economy. So to look at the economy, though, and if we think where we've been, say, the past 50 years, really, so many new things if you talk about technology. But then what those things can allow you to do as an individual and then certainly as a region. The internet, computers, cell phones, and even automobiles, really. Almost 3 automobiles per household today. So this is really a very different world we live in than just 50 years ago. So when you think about all that, what about jobs? And there are jobs, if we talk about the information economy, the knowledge economy, what does that really mean? But really, it is just simply the fact that everything is so integrated today, and there is so much in almost anything that goes on that is related with technology, manufacturing, professional services, tourism. You can't ignore any part of any operation. And so you can really have a little bit of all these things anywhere you are. And certainly South Carolina, this is manufacturing in the United States. And since we talk about Greenville in the upstate, this is our manufacturing powerhouse, really. And South Carolina as a region, this is from 1939 to today. So you can see a lot of people talk about manufacturing, and we think about manufacturing because it is so visible, so clearly visible, that it has been a very an up and down picture in the United States since 1939. And really since 1980s, early 80s, it's been having a really rough time, right? So some of the reasons for this, we won't get into so much today, but of course you're outsourcing and also technology, though. Technology really has done a thing where we are very productive with just less people. So we still have a lot of manufacturing going on, it's just not as labor intensive as it used to be. But in South Carolina, it's probably one of the brightest spots in the whole United States for manufacturing regrowth. And there is a lot of reshoring coming back to South Carolina, and there's been a lot of good news this past year in manufacturing throughout the entire state. So that was the picture of manufacturing. Let's look at service providing industries. A completely different picture, same exact period of time, starting in 1939, and it has just been increasing ever since. We've had, you can see certainly the recession that we're currently in, even looking at that picture, you can see it's probably the worst one that we've experienced. The downturn in jobs, not only in the service sector, but certainly in construction. But it's just been across the board. But the resurgence back has been pretty strong in the service sector. And certainly down here in Myrtle Beach, tourism is, which of course is our core. A lot of resurgence there. But certainly we are diversifying, as the topic is, just kind of as we grow. And we've grown as just a population about over threefold since, say, 1960. This is professional and business services. There again, you can see the last two recessions in the United States hit it very hard. just to give you some perspective of where we've been. But from 1939 through the present, just a significant increase where the jobs are. Certainly professional, business services in general. So this picture of our economy is just very different than it was 50 years ago, or even 30. Okay, unemployment rates. United States in green, South Carolina in red, and then Horry County in blue. These are not adjusted. These are the actual rates every month. So you see Horry County in blue are extreme up and down the peak and valley because of our extreme tourism type economy, right? But you can even see that the United States and South Carolina itself has a similar kind of movement, just not as extreme as we would here in Myrtle Beach. But the one thing you cannot help but notice is where unemployment is today, how much higher it is relative to, this goes back to 1994. We're still just sitting at a historically high level. And if I went back further, if you go back to, say, 1980 to 1982, the beginning parts of the S&L crisis was probably the worst time. And that talks really to how big of a factor construction is in the economy in general. And when I say that kind of thing, I don't want people to take the wrong idea that construction drives the economy. It's just the fact that construction is a big part of the economy, right? And really, what I try to emphasize is the core of any economy really drives that demand for housing. And the folks in real estate in the audience, we've talked about this quite a bit. But you see it here, particularly if we went back to the 80s, you'd see it even more. This is seasonally adjusted, so it's a little bit easier to see the trends. And it's very interesting. Actually, Horry County, 1994 through 2001, before the previous recession, Horry County had a lower unemployment rate than South Carolina and the United States, which is actually kind of an interesting statistic to look at. But we had a very healthy economy relatively in the 90s. And then as we came through that first recession, we started climbing a little bit relative to the rest of the country, and certainly now in this recession, construction just hit us hard. And as I said, for example, I was just in Colorado, went to Telluride, went into an appraiser's office, told him what I do, wanted to know about what's going on there. He said they're down 50% in Telluride. And just in perspective, these are Myrtle Beach, Telluride, Florida, California. These are destinations that people want to come to. And even in spite of that, the construction sector has just been hit very hard. And we're well aware of that here in Myrtle Beach, but it's hit everywhere. But you can see that we do have a pretty significant recovery going on in this area. And in South Carolina in particular, it might be a little bit difficult to see, but it's certainly closing the gap with the United States. And really it has been a story this year of economic strength in South Carolina. And I was just in Richmond before I left for Colorado at the Richmond Federal Reserve and heard economists from our whole region come and give their economic updates. And South Carolina really it's been a growth miracle the past 2 years. So it's a good time to be in South Carolina going forward. This is South Carolina's manufacturing employment. And again, as just with the United States, it was just a period of falling from where we were in terms of jobs all the way from before the 1980s. But the resurgence is significantly strong. So if we are at, say, down here, 2009 and 10, where we really bottomed out, the recovery has been, if we look at here, 10, 30, 20,000 jobs in a couple years in manufacturing, which is would really be very surprising to anybody that doesn't look at this stuff every day, to think we've added 20,000 jobs in manufacturing in the state of South Carolina. But we really do have a lot of activity going on. Of course, everybody's familiar with Boeing, and then here in Myrtle Beach, ITAP, what should start to develop there. It's going to be very interesting going forward, and the state's just going to get closer and closer together. And really that's what's happening in South Carolina. Greenville, Charleston, over here to Myrtle Beach, and on up, the whole state is just kind of closing around, particularly if you think some of the specific things. An interesting dynamic is tire manufacturing. And the way that tire manufacturing is happening and the reasons that it's happening and the kind of tire manufacturing, it's not for new vehicles. It's for used vehicles, which is a sign of our changing economic times. Again, the income growth going forward is going to be slower than it has been in the previous, say, 30 years. So people are going to hold on to vehicles longer. The fact that tire companies are looking at the secondary market for their new growth is just a little bit of evidence of that. They're looking at that and they're seeing that that's where their growth is. So they're making a change in their business model, and this is what we're all really having to do in our own models in whatever we do. This is real GDP. There's a lot of talk about the low growth rate in GDP, and it is. It's right now we're going at about 1.5% growth per year in GDP. Historically, say in the recent times, been between around 2.5%. Before, say 40 years ago, we were a 3 to 3.5% growth per year economy. We're just not there right now. But you can see, I mean, that's a dismal way to look at it. You can see here, even at 2 to 1, between there, it's a significant increase in just overall output. And so you just have to be on the good side of transactions. So very severe recession, but in terms of GDP, we're above where we were. Retail spending. This is another interesting factor. I spent a lot of my time analyzing the real estate economy. It's a big part of our economy, looking at building permits, construction, looking at sales, and it's interesting that in spite of the severe downturn in housing, to look at something like retail sales and see that does not look like a picture of a economy in recession. Spending is certainly going on. So the recovery in retail sales certainly well beyond where it was before the recession took place. But at the very end of that chart, you may not be able to see the downturn, but there is it's heading down here, all right? And that's the effect of gas prices, particularly. Gas prices did not climb in the beginning part of the summer, as was expected, and they actually came down compared to last summer. Now they're going back up, right? So this is not adjusted for inflation. Food and gasoline is the part of inflation that actually is increasing significantly over the past couple years. And so when that drop in gas prices took place, retail sales volume simply took a bit of a dip. But regardless, spending is going on. And one thing interesting about that is how, if you look at housing, it takes such a, well, for one, it takes debt, an immense amount of debt. It takes a loan to purchase a home, and the credit market is very tight. But for normal spending, there is income that is freed up for the regular spending, and that's what's happening in our economy. And this is something that Myrtle Beach in particular is benefiting from. So Myrtle Beach, as a tourist destination, we're seeing tourists come down, and we were on a panel a few weeks ago talking about if we could measure accurately the number of tourists that are here, say this year, compared to previous years. And each year, really, it just seems like for sure the number of tourists is increasing significantly each year. U.S. existing home sales, for about 4 years now, have been relatively flat. And that's, again, just been a reality of our financial environment. The Case-Shiller US 10-City Index, 33% drop in price since the peak. And so now what we're seeing, though, as a result of that price drop, is activity is starting to turn up a little bit. And we're seeing it here in Myrtle Beach, and it's starting to happen all around the country. Unfortunately, it's happened on the back of very low price. So price is driving that. So this is Horry County to put some perspective. I always talk about the two heads of our economy, tourism and construction. Those are the main juggernauts of our economy. Construction, this is single-family building permits to show what happened here and why it was so painful when it stopped. 1997, we were at 2,069 single-family building permits for the year in total. 2006, 6,452. And of course, increasing going up to that. Every month, more and more and more permits. So we simply have a lot of inventory. 2011, we had 1,415, roughly 75% of where we were in 1997, and we're a much bigger place. So there are a lot of challenges in construction, but we're starting to see a little bit of an uptick. Georgetown County, 1997, 533 permits. Not quite the run-up in Georgetown County, much smaller county relative to Horry County. 715 permits at the peak. And then 2006, 618, but 2011, just 128 building permits. 128 compared to, say, a normal period, 533 for the year. So all across, and it's interesting, I usually put a slide in there for Greenville, actually, because Greenville is a very diversified economy. It's a very strong economy, and to look at what happened to Greenville or even Charlotte, really the same picture, even though their run-up, their build-up wasn't anything like Horry County, which shows that the structure of finance today has really had an effect on building and sales volume going forward. So it's just a much more challenging environment. Tourism, on the other hand, this is the Horry County hospitality fee, which is probably one of the most reliable indicators we have. It doesn't have the changes in reporting that you get from the state data, so we track this as well as the state data, and it simply shows that really, we've had our record-breaking years the past 2 years in terms of collections from the hospitality fee, which is a good barometer of tourism activity in this region. So, it has been, even with unemployment rate as high as it is, there are certainly some bright spots in our region, and we're getting back to a better economy. We have a lot of work to do in that area, as does the rest of the country, and it's probably just going to be an environment for several years where unemployment is just going to be higher than historically. And there are policies that affect that, but it's going to be the reality going forward. So Grand Strand, I think what I just want to leave it with is to take away one of the most important measures of an economy or a market. The first thing you want to know about certainly is population. And that's an indicator. I grew up in West Virginia. If I showed this same picture from 1960 to today in Myrtle Beach, this is Horry County and Georgetown County combined. In 1960, 95,000 people lived in this Grand Strand region. Today, 335,000 people. So there's something going on. There is a reason to come here. People are coming here. Again, if you go up to the Northeast, particularly West Virginia, last time I looked, it might even be negative. It might have less population today than they did in 1960. So that is definitely a sign of progress and economic opportunity. And diversification is simply going to be a reality in that type of environment. The more you grow as a region, the more that is going to be demanded, the more that's going to be provided, exchange of ideas, opportunities. And I was talking to Brad Lofton just earlier. Some of the announcements that are going to be coming forward today in Myrtle Beach, just sometimes they can come out of nowhere, just surprise you. And a relocation of a headquarters, for example, just starts to happen. It gets to be a better environment for these gentlemen, helps make their job easier, and we start to see some successes.